Hello everyone, welcome back to my YouTube channel. Today's update brings an important development from Vietnam's foreign exchange market that is drawing attention from economists, investors, businesses, and everyone following the Vietnamese Dong. The latest figures released on June 30 show that the State Bank of Vietnam has adjusted the daily reference exchange rate to 25,206 Vietnamese Dong per US dollar, representing an increase of 5 VND compared with the previous trading day. At the same time, the central bank maintained the existing trading band of plus or minus 5%, which means the ceiling exchange rate for commercial banks during the day stands at 26,466 VND per US dollar, while the floor rate is 23,946 VND per US dollar. Early trading also reflected slight adjustments among Vietnam's largest commercial lenders, with Vietcombank and BIDV listing their buying rate at 26,126 VND per US dollar and their selling rate at 26,466 VND per US dollar, both increasing by 5 VND from the previous session. Although these changes appear small, they provide valuable insight into how the State Bank of Vietnam continues to manage exchange rate stability while responding to both domestic economic conditions and global currency movements. A 5 dong adjustment may seem insignificant when viewed in isolation, but Vietnam's exchange rate policy is built around gradual, carefully measured changes rather than sudden or dramatic movements. This measured approach has become one of the defining characteristics of Vietnam's monetary policy over recent years, helping maintain confidence among exporters, importers, foreign investors, and financial institutions. The reference exchange rate serves as an important benchmark for commercial banks and helps guide daily foreign exchange transactions throughout the country. By making only modest adjustments, the central bank signals that it remains committed to maintaining orderly market conditions while allowing the exchange rate to reflect changing economic realities. Market participants often examine these daily updates not only for the numerical change itself, but also for what the adjustment may indicate about the central bank's assessment of broader economic trends. Global currency markets have remained influenced by expectations surrounding U.S. monetary policy, international trade developments, inflation trends, and capital flows across emerging economies. Whenever the U.S. dollar experiences periods of strength or weakness internationally, central banks across Asia carefully evaluate the potential implications for their own currencies. Vietnam is no exception, given its deep integration into global trade and manufacturing supply chains. As one of the world's leading export-oriented economies, Vietnam benefits from maintaining a relatively stable exchange rate that supports competitiveness while limiting excessive volatility that could increase business uncertainty. The slight increase in the official reference rate therefore reflects ongoing efforts to balance multiple policy objectives simultaneously. Another important point is that, while the reference rate increased modestly, movements in the broader foreign exchange market can vary depending on commercial bank demand, corporate transactions, foreign investment inflows, and seasonal trade activity. Businesses importing raw materials, machinery, or consumer products closely monitor exchange rates. Because fluctuations directly affect their costs, exporters also pay close attention, since exchange rate stability influences international pricing and competitiveness. Foreign investors evaluating opportunities in Vietnam similarly consider exchange rate management as one factor when assessing long-term investment prospects. Vietnam has continued attracting significant foreign direct investment thanks to its expanding manufacturing sector, improving infrastructure, competitive workforce, and strategic location within Asia. Stable monetary policy, including prudent exchange rate management, remains an important element supporting that investment environment. Financial analysts note that daily changes of only a few Vietnamese Dong generally indicate a controlled and orderly market rather than one experiencing significant stress. the State Bank of Vietnam has consistently emphasized maintaining macroeconomic stability while ensuring sufficient liquidity within the banking system. This strategy has helped Vietnam navigate periods of global financial uncertainty with relatively limited disruption compared with many other emerging markets. International developments, including changing expectations for US interest rates, global inflation trends, commodity prices, and geopolitical events, continue influencing currencies markets worldwide. Against this backdrop, Vietnam's central bank remains focused on balancing inflation control, economic growth, financial stability, and exchange rate flexibility. The modest 5 dong increase, announced on June 30th, should therefore be viewed within the broader context of a carefully managed exchange rate framework, rather than as an indication of any sudden shift in monetary policy. Investors and market observers will continue monitoring future daily reference rate announcements for signs of evolving economic conditions, but the latest adjustment primarily reinforces the central bank's commitment to gradual and predictable management of the Vietnamese Dong. As Vietnam continues strengthening its role as a major manufacturing and export hub, maintaining confidence in the national currency remains an essential objective supporting trade, investment, and sustainable economic growth. Overall, the June 30 update reflects stability rather than volatility, demonstrating that Vietnam's monetary authorities continue taking a cautious and measured approach to exchange rate management while adapting to developments in both domestic and international financial markets.